Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you're curious about how the One Big Beautiful Bill will help you protect and grow your assets, stay tuned. What's our topic today? It is the three questions business owners and investors should ask about the One Big Beautiful Bill. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. On this episode of the podcast, we're diving into the game-changing One Big Beautiful Bill, or OBBB. We'll have to figure out which one we're going to use during the podcast today. Signed into law on July 4th, 2025, it is a sweeping tax reform package that's set to reshape deductions, estate planning, and business taxes for years to come. Now, joining us from beautiful Miami, Florida is Yoandry Delgado. He's a seasoned CPA and a partner at KSDT CPA. He has over 20 years of experience specializing in individual and corporate taxation. He has helped countless clients navigate complex tax landscapes from estate planning to business deductions. Yoandry, great to see you. Welcome to the podcast. Great to have you on. And we're going to dig into the three questions that business owners and investors should ask about the One Big Beautiful Bill, or the OBBB. Thank you for making time to take us time to join us today. Really appreciate it.
No, thank you, Wayne, for the pleasure and the honor to be able to join your podcast. I've been
You-
following for months now and
Well,
really enjoy.
this has been something I've been poking and prodding, and when the new bill came in, I said, "Aha! Now we're going to get Yoandry on here." So, before we get into all the tax discussion here, I think just for the folks listening in today across the country and across Canada as well, by the way, why don't you just maybe give us a little bit of a background of your own expertise and tell us a little bit about your firm.
Yeah, absolutely. So again, Yoandry Delgado, I'm a CPA and tax partner with KSDT. We have offices throughout South Florida, four to be specific. We also have an office in Charlotte, North Carolina. We specialize really in working with investors, business owners, and high net worth individuals and families to help them with their tax strategies, tax planning, of course, tax compliance as well. But we pride ourselves on being a proactive firm. So of course, when this OBBB came out, we really started working hard to give our clients the updates and the reassurance that they needed to make sure that they knew that we had their back and that we were going to do everything in our power to make sure that this bill will work to their benefit, their benefit. So yeah, we're about 300 employees strong. With that, of course, comes a lot of wealth of knowledge and experience. So we can definitely service clients not only throughout the United States, but also foreigners conducting business here in the US as well. So we're very
So
proud of.
international clients looking to relocate, like for example, a Canadian family looking to relocate to the US, you're able to give
Absolutely.
them some guidance and direction as well. Is that right?
Absolutely. Yeah, we work very closely with we've had a lot of Canadian clients that have relocated here. In addition to that, we also work with US taxpayers that are living abroad. So we're very well versed in all the complexities that, entail those types of relationships, and we can definitely help our clients navigate them very
Perfect.
successfully.
From what I can tell, the public's initial the consensus, sort of the feeling about the OBBB, I guess that's what we're going to call it today, instead of the One Big Beautiful Bill that comes tripling off the tongue. It appears to be mostly positive, especially among business owners and investors. And what we're hearing from them is that they really like obviously the tax cuts. Everybody kind of likes that. Um, Early sentiment is it's a win for the economy, for economic growth, for simplifying taxes. Now, there are critics that worry that not enough attention was putting to, addressing, I would call it broader, more, fiscal challenges the U.S. economy is facing. So, from your standpoint as a CPA, and
Right.
I'm not going to I'm not going to box you into a political discourse here, my friend, but just from a CPA's perspective, do you think it's really too early to give the OBBB a passing or failing grade? I mean, are you already sitting here saying, no, this is a win, or are you sort of on the fence still?
Yeah, so that's obviously a great question. The one thing that I will say, I think it is too early to say with 100% certainty this is a win. But with that being said, from purely a tax perspective, I see some things that are very, very attractive to our clients in this bill. Some positives, of course, include maintaining the top individual tax rate at 37% instead of the 39.6, significantly higher standard deduction, and expanded benefits for some of our elderly taxpayers. Of course, a more generous state and local tax deduction, that's extremely attractive and it's going to help a lot of people. The permanent 20% QBI deduction, that's also extremely beneficial to business owners as long as they meet certain criteria. So I think there's a lot of really good benefits from this bill, purely from a tax point of view. And I didn't even touch on one of the biggest ones that we'll kind of touch on later in this conversation. But I would say from a tax point of view, I'm pretty excited about this bill and what it can mean for a lot of our clients.
All right. So we are discussing the three questions business owners and investors should ask about the one big beautiful bill. Yonder, let's get right to work. No delays here. Let's get at it. So these questions are from the perspective of either an investor or a business owner. So question number one, how will the one big beautiful bill impact my personal income tax deduction?
Yeah,
Yonder, take it away.
so for most of us, of course, the thing that's going to affect the majority of the population is going to be either the standard deduction or the itemized deduction. The great news on the itemized deduction point of view is what I referenced earlier, the SALT, so state and local tax deduction, that's been increased from $10,000 to $40,000. So what does that mean? That means that if you're a high net worth individual and let's say you're living in a highly taxed state or you pay a lot of real estate tax, now you can take advantage of those taxes that you're paying either in other states or your personal real estate taxes up to $40,000 instead of the $10,000 that we were previously experiencing. However, let's say you are not an itemized deduction filer because you don't own a home or you don't have mortgage interest or real estate taxes, whatever the case might be. Well, the standard deductions have also been increased. They're now for married couples, they're 31,500. For single filers, they're 15,750. And then for heads of household, they're 23,625. In addition to that, taxpayers that are 65 and older with incomes under 75,000 if single or 150,000 if joint, they also get to enjoy a 6,000 additional deduction, up from just 1,600, what it used to be before. So they also get to take advantage of that additional $6,000 deduction. Some of a very general and simplistic point of view, in my opinion, those are some, pretty nice wins and some pretty positive impacts there for most taxpayers from a deduction standpoint.
So if you're a business owner in one of these, states, states like California and New York, where they're realizing much higher taxes, are there strategies that they can use to maximize, I guess it's basically a temporary state and local tax cap increase. Are there any strategies they can employ that would be different than just the regular consumer that you were talking about earlier?
Yeah, absolutely. If you are an investor or self-employed or have a business, and let's say you're conducting business in several states, number one, you have the opportunity to maximize what's called a pass-through entity tax election or PTE. And what that allows you to do is to essentially pay for the tax on the entity level instead of the individual level, and therefore really getting the most bang for your buck, if you will, from that state tax deduction because you can deduct that 100% on the business level. However, let's say you don't do that, again, you can still enjoy up to the $40,000 deduction. Worst case scenario, you still have time to plan for that when that $40,000 deduction phases completely away. But let's
That's like
just say that
2030, right?
yeah, exactly. So let's just say that you don't have state and local taxes, but you do pay a hefty amount of real estate tax right now, from now until it totally phases out, or even in the current year, you have the opportunity to almost also prepay your real estate tax bill if you have that option available to you to get really the most benefit out of that additional deduction as well. So those are just some things that you can still implement and use to your advantage.
And so when you're working with clients, these are some of the brainstorming and I could we call it, brainstorming or galaxy braining that you're doing with your clients just ahead of time to help them maximize or minimize the amount of tax they're having to pay. This is all a part of the planning process that you go through with a client.
Absolutely. So we have with a lot of our clients, we have regular meetings throughout the year. We call them, tax planning and strategizing meetings. And we follow whatever cadence the client really feels they need. And of course, as long as we're in agreement with that, just because, we have a responsibility to always do what's best for our clients. So if they're asking for monthly meetings, but we feel that that's not necessary, we'll of course be forthcoming and let them know that we can achieve the same goals from tax efficiency point of view without having such a high cadence with our meetings. But these are just some of the things you're absolutely correct that we will discuss with our clients to make sure that they're in the most tax advantageous position possible throughout the year.
I got a question. I just thought of this now. Like in all the clients that you're working with on the individual space, how many would you say it's a 50-50 breakdown between clients that do itemized versus standard deductions, or do you see a trend in one way or the other? Just based on your own experience working with clients?
Yeah, that's a very good question. I would say, because remember, we work mostly with high net worth individuals. So
Yes.
usually we're dealing with clients that are really atomizing deductions more than not,
Hmm.
just because they usually have, of course, real estate holdings under a personal name or their own primary residence. So when you have mortgage interest, real estate tax deductions, charitable donations, then the itemized deductions are really what's most beneficial for taxpayers. So I would say in our particular practice, we experience more working with taxpayers that do take advantage of itemized deductions.
Interesting. Okay,
Yeah.
Yonder, let's get on to our second question here. Question number two. Now that the estate tax exemption is permanent, do I need to reconsider my overall estate and tax planning strategy? I don't know.
Yeah, absolutely. And here's why. So the exemption was set to revert back to the base of 5 million after 2025, adjusted for inflation, of course. So what that means is that that was going to be about half in 2026 of what it was
Everybody was dreading the
the
calendar
phase out,
clicking over from December
the
31st,
sunsetting.
25.
Right. So of course, now that that urgency has kind of been lifted a little bit, people initially are thinking that they don't really have to address it any longer, this, that, and the other. But although the OBB permanently increased the lifetime estate and gift tax exemption to 15 million if you're per individual, so 30 million per couple, if you will. um that's not, and even though we think it'll be permanent, of course, you know how that works, right? It's permanent until another administration.
Until there's a turnover in from the red to the blue team, maybe, or
Exactly. So really, you never, that permanent, it could be temporary. So we still work with our clients. And even though, again, this is, in my opinion, something that's really positive for high net worth individuals and families, we still want to be cautious, right? We don't want to say we don't have to think about it, or we don't have to strategize around this, and let's just leave it at it as is. We still have really good conversations with our clients, very proactive conversations. And you know, planning is still critical in our opinion. So when we're talking to wealthy families, we still, urge them to use gifting strategies to lock in the exemptions, or evaluate whether a grantor trusts, grats or slats make sense. These different types of trust would make sense for them, and we educate them on what the potential tax benefits or repercussions could be of following those types of vehicles. And then, of course, we also one thing that we as a firm can assist them with as well is considering valuation discounts where applicable. If they have closely held entities, etc., we as a firm can perform the valuation as well. That's an added service that we provide. So we walk them through what that could mean and what the potential benefit of that could be for them. So we still think that it's worthwhile to continue exploring these different avenues, because you never really know what's going to happen in 2 or 3 years from now, even though we think these exemptions are going to be permanent.
well, the term permanent is maybe not quite so permanent. It's as permanent as, the writing your name on the beach and the
Yeah,
tide comes
yeah.
in and it's gone. Um,
Exactly.
okay, you just sort of prompted a follow-up here. So we know that we have, in our practice, obviously we have high net worth clients as well. And so for clients, say we have significant assets, say over $13 million of liquid assets, should they be adjusting their strategies and minimizing, taxes,
Mhm.
and looking at, you talked about gifting and trust, like where do you say to clients that in terms of liquid assets that they start to have to really rethink the
Yeah.
strategy, especially, because if let's just sort of have the hope that not only do we get this sort of fixed or permanent increase, but it's going to be indexed with inflation too, assuming it's going to stick around. If it does stick around, it's going to be increased. So is there like an investment strategy changing here as well, not just overall assets?
Yeah, I believe so. So typically when we have clients, some of the things that will, to expand on what we talked about earlier, some of the things that we'll go into in detail is looking into multi-generational planning using, for example, dynasty trusts. Dynasty trusts could be a great vehicle because they help minimize the impact of various transfer taxes, of course, including federal estate tax, gift tax, and generational skipping tax, transfer tax. So that could be a huge benefit that will and a good opportunity for our clients that will walk them through and make sure that they understand the tax compliance aspect of it and then some other regulatory obligations and compliance issues that they need to understand before taking advantage of that vehicle. Um, in addition, to that, I like to dive a little bit deeper into what the valuation discounts really could mean for a client. So, we'll speak to them about that and the the way that it works with valuation discounts is, when you're transferring ownership interest in assets like privately held businesses, real estate, or even family limited partnerships, discounts work to reduce the taxable value that's being transferred of the interest, for gift and estate tax purposes. There's two really main types of discounts that we would talk about. Number one would be a discount related to the lack of control. So that would be something that we would entertain when a particular client has a minority interest, or non-controlling interest, in an entity. And then the other
These are
would be
privately held, not these are obviously privately held.
exactly, exactly. And really, the reason why we would pursue a discount under that frame, right under the lack of control, is because the owner really lacks the ability to influence or control business decisions. So it makes sense that their interest wouldn't be as valuable as someone that could exercise, right, that control. So that's where we approach it from that point of view. And then in addition to that, the lack of marketability. So of course, that reflects the difficulty of selling interest in closely held businesses or assets that are not easily marketable, like publicly traded stocks, right? Something that's not as easily the value is not as easily readily available. So that's when we can take advantage of that. So those are some of the vehicles and topics and opportunities that we'll bring to our clients. Usually when we're looking at 13 million, 15 million in value of assets or above.
Okay, so Yoandry, thank you very much again. Yoandry Delgado is joining us here from beautiful Miami, Florida. Thanks again, Yoandry, for making time for us and great insight on the three questions investors and business owners should ask about the one big beautiful bill. We're going to go to question number three, and this is really more of a business owner focused question. How will the permanent extension of the 20% qualified business income, otherwise known as QBI,
Mhm.
how will that deduction affect my business tax planning strategy? You're Andre Delgado.
Yeah, so the QBID, qualifying business income deduction, is something that we've been using, for years now, and it's now permanent, right? Which I'm happy to see because this is something that really affected, I would say, the majority, if not all of our business clients, and we would take advantage of that. So the fact that it's now permanent enables us to continue counting on that vehicle or that opportunity in our tax planning, the regular tax planning meetings that we're having throughout the year, et cetera. So it means that owners of qualifying businesses now can continue deducting up to the 25% of qualified income, which effectively lowers their effective tax rate. Of course, there's some caveats to that. So, you need to have wages or qualified property. So we work with our clients to make sure that the wages are at the most optimal level to be able to maximize that deduction and use it to its fullest potential. So we also plan for income thresholds carefully to stay within the limits so that it doesn't start to phase out, and we try to use other deductions to the best of our benefit and our ability to be able to, again, that to be able to make sure that that QBI deduction doesn't continue to phase out or start to phase out. And then this is something small, but it's also something that was included in the bill and could be beneficial for some clients as well. So there's now a new minimum deduction of $400 for those with at least $1,000 of QBI starting in 2026. So that may not seem like much, but every little bit counts. And I'm a true believer that if I could keep a dollar in my pocket instead of paying it in tax dollars, I want to follow that opportunity and make sure that I take advantage of it. So, that's still something that, even though, let's say we have a client and they're not seeing a huge qualified business income deduction, we still make sure to mention that aspect of it to them, so at least they get the benefit, even if it's a much smaller deduction.
I like that what you just said about trying to keep money in my pocket as opposed to giving it away. One of the things I try to dissuade my clients from is when it comes to withholding tax on their income, like on their IRA
Yep.
RMDs, is, some people they want to overpay and get a refund. They think getting a refund is the greatest thing. I said, no, no, no. I think it's better, even if you owed $500 at the end of the year. It's far better than getting a $3,000 pay check from the government at the end, because
Yep.
that means you've just lent them 3,000 bucks that could have been in your pocket. So
Exactly.
try to keep it as close to the line as possible. So
Yeah,
like,
it's fun. I'm glad you mentioned that because I literally had a conversation with a client this morning, and he actually sent me his W-4 because he wanted me to help him kind of prepare it in a way where we would lower the withholding as much as possible so that he could take advantage of being able to use his assets throughout the year and obviously
good for him.
invest them wisely and invest them in products and vehicles that will of course appreciate. So that's very prevalent, especially nowadays when there's the IRS is in such a flux with all the new IRS agents coming in. So, and just the state of it, that clients really feel uneasy having such a big overpayment and then kind of being in doubt or having to worry of when am I going to get my refund when I ultimately do file my tax return. So, honestly, it's a personal preference. Some taxpayers prefer to pay throughout the year because they know themselves and they know that they're either going to burn through the money or they're not going to invest it
It's
wisely. So
a terrible way of forced savings, though, man. I think we could come up
yeah,
with, as a financial advisor, I can say we can come up with some better strategies
yep.
than giving your money to the government.
I would agree with that as well.
Just one thing before we wrap up here. Well, a couple things actually, but I was thinking about, people who have, pass-throughs or pass-through
Mhm.
entities or LLCs,
Mhm.
pretty common. Are there any specific changes in the one big beautiful bill uh, that business owners should be thinking about from the perspective of having one of these pass-through entities in regards to the legislation? Is there anything that you should be thinking about? Whether it's, is there a way that should they be restructuring anything related to the QBI
Mhm.
or restructuring income investing? Is there anything
Yeah.
with LLC owners that they should be thinking about, or
I wouldn't say that this bill specifically brought any new thoughts or any new ideas that would cause a taxpayer to say, maybe I should be operating under a different structure. I think that we would probably we do that anyways regularly throughout the year and really, year over year, just because even though, let's say, for example, the QBID might have gone away, there's still benefits to entertaining other entity structures. Like if you're operating under a sole proprietorship, then all your income that's being generated, if you're being taxed as a single member LLC, is subject to self-employment tax for the most part, generally speaking. So with that type of client, we would talk about, potentially converting to an S corporation, and we would educate them, of course, on what the responsibilities and the obligations of conducting businesses in an S corp would look like to make sure that, they would get that return on investment from making that transition because there are some costs associated with an S corporation. So these are things, the reevaluation of entity structures are things that we do anyways, I think the fact that the QBID is permanent now, though, kind of pours a little bit more gasoline on that, if you will. And so we're actively, having that conversation even more now, because that's something that we can count on permanently. So we're still having those conversations. There are some other, vehicles and some other really, really important aspects to this bill that I know we haven't touched on yet that, I like to touch on. For example, the section 179 expensing, right? So for certain assets that you purchase in a business, you can expense 100% of those assets. In addition to that, the bonus depreciation aspect of it, that's huge for business owners as well, especially in real estate. If you're in the real estate sphere, or if you're an investor in manufacturing or those types of industries, that can be significantly beneficial for you as a
Yeah,
business owner.
we're actually going to have my friend Joel Dobrin on here in the next couple 3 weeks to
Mm.
talk about that. He's a cost segregation specialist, and I just talked to him a few days ago, and can barely contain himself. Would be the
Yeah, I'm sure he's a happy camper.
Yeah, for sure.
Yeah.
Okay, so we've only really we scratched the surface here. There are some other tax changes. I'm just going to really quickly, no federal tax on tips and
Mhm.
overtime, tips up to $25,000 a year, overtime up to 12,500 a year. Now, car loan interest deduction, if the car is made in the US, and as I understand it, it's for loans going forward. It's not retroactive. Is that right? So for
That's
car
right.
loans, in other words, you can't deduct a car loan it's got to be for something going forward that you have to,
Exactly. Right.
right? And
Yeah,
also, oh,
go
go
ahead.
ahead.
No, I was gonna say that's absolutely correct. Yeah, it's you cannot, of course, apply that benefit retroactively. It's moving forward.
And I did some due diligence on this. There are vehicles that are quote unquote has a foreign brand, but if they're made in the US or the
Mhm.
majority was made in the US, it would qualify. So
Yep.
you don't have your classic Ford or GM or you
Exactly.
may have a
Yeah.
foreign name, but if it can be shown to be primarily built here in the US, it would qualify.
Yeah, I think, and I could be wrong, so don't hold me to this, but I think Nissan would be one of those examples. I think Nissan is mostly built and assembled here in the US, I believe. So I think that would be a prime example of that.
Yeah, I checked my vehicle, and unfortunately, my particular series was not. Which
You
anyway, I guess
gotta
it's time
purchase
for. I
another
guess
one.
if there was ever a
You gotta purchase another one.
the motivation for a trade-in, that's it. Okay,
Yeah.
one other something I'm probably for folks that listen around the country that are in sort of disaster-related areas. There's disaster victims in this year can claim a personal property loss without having to itemize. So that's just another one.
Yep.
You
That's
we talked about it already, a few game changes, but and we talked about, cost segregation. Is there one, just before we wrap up here, is there any other game changers in the bill that you've discovered? Do you think we've covered them all, or is there anything else that kind of
I,
raised an eyebrow?
I think we've covered, some of the major ones, right? Or most of the major ones, but I do think there are some others that are very important. For example, I have two kids under six. So, of course, the child tax credit is a huge benefit for me, or it's a nice benefit, I should say. And so I'm sure a lot of parents, across the country feel the same way. So that's been increased to $2,200 instead of, per child, instead of the 2,000 that I think it was. So that's beneficial right there. I think also the charitable donations, even if you don't itemize, you can now take advantage of some charitable donations as a deduction, even if you're not an itemized taxpayer. So that's definitely helpful as well. So there's definitely still a lot to the bill that, it's impossible for us to touch on
I think I
everything
would
here, but
add one more too. I just
yeah.
thought of it as you're talking. When you're talking about the first one is the 529s now. We're going to which is the education savings plan.
Yep.
I think they now allow for a broader
Definition
definition.
of, yep.
So there's a wider range of education opportunities that you can use that plan for. Uh,
Absolutely. So I had a client that actually asked me about this back in June. and they were asking me about a 529 if they could use that for homeschooling expenses. And of course, back then in June, that wasn't an option. But now because of this, because of the OBBB, that's the definition I think has been expanded now to include homeschooling expenses. So I just had a conversation with him yesterday about that. And of course, these plans are still governed by the states, but as long as the states, traditionally have followed federal law, then, it shouldn't be an issue, right, for them to be able to use these funds for homeschooling. But that's something that's also attractive to a lot of taxpayers and can be beneficial.
Yoandry, you've been just amazing, great information today. I'm sure folks listening in, not just across the great state of Florida, but around the country, are thinking they wouldn't mind talking to you. And for those who are, watching us on our website here, they can see your contact information. But if you're listening on Apple or Spotify and driving around in your car and you obviously can't see your screen, or hopefully you're not, what's the best way for them to reach you? How's the best way to contact you?
Email is always good just because, of course, you can give our office a call as well. Our main number is 305-670-3370. But from time to time I'm in meetings, so you might not be able to reach me. But of course, our receptionist will take a message and I'll get back to you. But my email address is ydelgado@ksct-cpa.com. So ydelgado@ksct-cpa.com. That would be the best way to get a hold of me. And we can schedule a meeting if a potential client would love to jump on a Microsoft Teams meeting or something like that and have a conversation about how we can help.
No, Andre, you've been great. Great guest today. Really thank you for making time for us and providing such great information on the One Big Beautiful Bill. Thanks very much for joining us today.
Thank you so much, Wayne. Really appreciate the opportunity and got to do it again sometime soon. I love this.
Undoubtedly,
so
it's
much.
going to be, well, like we said, it's permanent, quote unquote, not wink, wink, right?
Right. Yeah.
So, Yoandry Delgado joined us today from Miami, Florida. He's a CPA with 20 years of experience plus advising business owner and individual clients. I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Now, lastly, but not least, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.